Today we're going to talk about 4 reasons. Have you ever been so wealthy that you didn't have to worry about any unexpected expenses or surprises or...
Not yet.
Yeah,
We're getting there.
So I've run across a few of those people. I was actually having dinner with a guy who I would consider very wealthy. He's got that mailbox money. Had a couple of oil wells do really well. But he was talking about somebody that he considered really wealthy. And he goes, I just want to get to that point where I don't look at the right side of the menu.
Oh.
Okay. And if you've got all your retirement assets in the stock market or in taxable accounts, do you really have, I don't have to look at the right side of the menu money? Because you don't know what's going to happen with taxes and you don't know what's going to happen with the stock market.
Yeah.
But we are going to talk about 4 reasons, because a lot of these people have so much money, they self-insure. They don't like giving that little bit to the middleman that is the insurance company sometimes. Right. Anyway, I'm Mark McKay.
And I'm Marcy McKay.
Welcome to Sage Smart Solutions. Please join us weekly as we look at new and exciting ways to protect your assets and retire tax-free. So, all right, I've never been a really big fan of long-term care insurance, but I'm even less of a fan of paying long-term care bills.
Right.
I've seen the bills. I've seen how quickly they can deplete a retiree's assets and the surviving spouse's assets. I've sat through Medicaid planning. It's basically, these expenses are so high that we have to try and deplete the surviving spouse's assets. Anyway, but we're going to look at reasons why people who, don't necessarily need protection buy the protection.
Right.
And I'm not talking about just the math of it. Makes more sense if we look at it on a spread. I'm talking
Right.
about real world events that can happen that they are very grateful when they have taken care of protecting against these long-term care expenses, which are devastating and more likely than we'd like to admit. So
Absolutely.
let's take a look at it. Today we're going to talk about 4 reasons that the very wealthy buy long-term care insurance. And like I said in the opening, I'm not going to go through the math of, if we take this asset and we use it, then, you're paying 100 cents on the dollar. Whereas if we fund it with life insurance, we can pay for it with 6 cents on the dollar if you never
Right.
need that. We're not to that point. What I'm talking about is actual real world issues that I have seen people, because I've got clients that I don't care what the long-term care expense is, it's not going to move the needle on their lifestyle. They could write a check for it. But a whole lot of those people, we've talked in the past about the Wealthy Leave clues, about how I've
Right.
learned more from being around very successful CEOs, doctors who have 20 doctor practices that they manage, the guys that you're kind of trying to figure out how they made all their money because they didn't just go put it into mutual funds and whatever.
Right. They have very entrepreneurial spirits, whether their career is or
but
not.
this is one area where I really, kind of both sides of the coin. The concept of people who are self-insured blew my mind a little bit. I mean, I've got people that if their house burns down, they're going to have to go write a check, and they wanted it that way. They ran the math, and then I've got some who are the other extremes.
Okay.
So,
Right.
one of the main reasons that these people are going ahead and buying long-term care protection of some sort, and I have my own biases against long-term care insurance. So don't just throw us out with the bathwater and say, well, my Aunt Peggy had her premiums. I know what happened to Aunt Peggy with a lot of the traditional long-term care policies. So
sequence of return risk, what does that mean?
Sequence of return risk. If you're not familiar with this, go back and watch our biggest risks in retirement, because a lot of these things are the same issue. Is that it's great to have all your eggs in one basket, unless something bad happens to that basket and you need that egg. You need an egg.
Right.
So if your plan is, I've got $3 million over here in my Bitcoin. Let's say you're a very affluent person. and oh wait, I've got $1.2 million in my Bitcoin. I hadn't checked it in a little bit. Do you want to have to, take that lower price, because you can't predict when, I guess you could predict, but you can't accurately predict when you're going to have a long-term care expense.
Right. Life happens.
And regardless of how much money you have, I've got a few people that probably it wouldn't phase them, but I've also got some, some doctors and some oil men that steadily made seven figures that, the $120,000 a year they're spending on long-term care, assisted living facilities, it hurts.
Right.
That's a trip to Europe every month. It's,
right.
It just, not a great one, but it gets you there.
Right.
So sequence of return. And basically it's, if you're going to use, assets that move up and down in value, that don't have complete liquidity, that are risky, like your growth mutual funds, your bond mutual funds, your ETFs, you're going to be exposed to sequence of return risk. So basically, this could be a very bad time to sell that asset to pay for the long-term care expense. So, I hope I went the wrong way. Number two, tax risk. This is kind of like if we go back to the Bitcoin example.
Right.
Let's say that you've got a few Bitcoin and you don't really want to sell it because it was worth 3 times as much 6 months ago. But also you don't want to sell it because it was worth 1/10 of that when you paid for it. So you have all this big, and despite what this, I can't give tax advice. I can. Pay your taxes. So don't pay more than you have to, though. Taxes are going to be higher. Okay, I'm being a smartass. So, but let's say you've got $1 million worth of Bitcoin and you have $100,000 cost basis. Even though you may think that you're going to be able to pay your nursing home expenses with your Bitcoin, the way it works now is you are essentially exchanging your Bitcoin for $1. So that's a taxable transaction. So whatever you paid for the Bitcoin, So do you want to, one, have this big, you've got this long-term care expense. Oh, and all of a sudden I've got to give 20% of my Bitcoin portfolio to the IRS. So tax risk is a really serious thing that you expose yourself to when you self-insure. All right, what's our number 3 risk? This is a big one. The loss of the step up in cost basis. And if you don't know what that means,
not a clue.
Then it probably doesn't apply to you. you do, because you have Marcy's grandfather had a bunch of properties and things, but this is actually from a tax planning aspect and from an estate planning aspect. It's one of the biggest things that you have working for you. So basically, let's say Granny's got the shoebox that it turns out has $3 million worth of AT&T stock in, with all the splits and,
right.
What our G stock or whatever the case may be. That's great, but she paid $42 for it back in 1907. And so it's almost pure gain that is going to be taxable.
Oh, okay.
So let's say you paid $1,000
right.
for this stock. It's worth $1 million today. If I give that stock to you, I've got to, there's different ways to do that, but if I just sell that stock, I'm paying capital gains tax on essentially $1 million.
Right.
If I die and I leave it to you, even though your cost basis is kind of zero, you didn't put anything into it, all that gain disappears. Okay. So your cost basis is now the $1,000.
Got it.
Or the $1 million. I've talked myself in a circle here. So it's really a great way to, when you have these appreciated assets, say you've got a piece of land. Let's say you got a house, in old Austin, and your parents paid $60,000 and the lot alone's worth $4 million now.
Right. Okay.
They don't want to sell it because they're going to have to pay taxes on $4 million. It's a little different with houses. There are some bigger exemptions, but if they leave it to you and you inherit it, the current market price is your cost basis. So, all that gain that nobody had paid taxes on kind of disappears. So it isn't big to lose it. So basically, let's say you've got some stock or you've got some real estate, and you're thinking, if I ever need to go into that $120,000 a year facility, I can always liquidate these assets. Well, you can, but do you want to? Do you want to have this big expense happen and have to give a gift to the IRS? Do you feel like Congress needs to benefit from your retirement plan?
Right.
Or your long-term care plan?
Because we're all not already giving enough to Uncle Sam.
So this is similar. This would be when people have business succession plans. A lot of these strategies actually, we work with farmers and ranchers, especially in the Texas Panhandle, and a lot of the big advanced planners will focus on those types of plans or those types of industries because it's complicated.
Right.
If you've got an agricultural industry, you've got a farm or a feed yard or a small ranch or whatever that's got 18 different employees, it takes a lot to keep it going. And if something happens to one of the major partners, you can't just shut things down. Let's figure out a valuation. But you need to have plans in place to keep it going. We're gonna focus on that more in some upcoming episodes. But if you have a lot of your business or your network tied up into a small business, and you have a long-term care event happen, and you need to access or to generate income from that, do you have the liquidity in the 2 sections of land you have that is collecting CRP and lease payments? And you need to have a plan and have options so that I think it really, and it's not just long-term care planning, but retirement planning, income planning. If you've got everything in a tax-deferred bucket, now, whatever you can get in your Roth, get in your Roth. Whatever you can't, call me. We have the best IRA conversion strategy out there. I'll put it up against anything because all their plans, you reduce your principal because you have to pull money out to pay taxes in the first year. We have ways around that. So I've gotten off track here a little bit, but
it was a good track you got.
But these are 4 reasons that I've seen in the real world that the guys that take their little plane to go get on their big plane type of businessmen,
and how we can learn from them,
and lessons we've learned from them, and especially when it comes to some of these expenses that a lot of us, 50% of us are going to have to deal with this. And it's not always, grandma's going into a nursing home and is going to be there for the next 7 years. Sometimes it can be a 6-month stint based on a medical, you fall and you break your hip and you need long-term care. So anyway, watch the masterclass below if you'd like to learn how you can protect your asset. I'm not a big fan of traditional long-term care insurance. Let us show you some of the strategies we use that can take care of tax diversification, get rid of stock market risk. It's going to be risky, and taxes are going up. So watch the master class, schedule your strategy session. Let's put a plan in place for you and your family today.
Right, to better protect your money, your family's financial future.
Absolutely. Have a great week.